Hey guys, I hope you and your families are doing well, and I hope you're ready for an in-depth trading video. So we've got some primary learning points to be going over. That's going to be more centered around the candlesticks, understanding what is really going on there when you look at price, when you look at volume. Then we've got some secondary learning points as well. Now they're going to be more down in the weeds and more in depth, but it'll all make sense as we progress throughout this video. So we're going to be looking at all four parts of the process in this video. The identification stage, what do we want to see before a stock even starts basing? What do we want to see in the base, so the chart pattern that is building, understanding things from a supply and demand perspective. How do we then want to think about controlling risk, creating asymmetric risk versus reward trades? How do we want to think about mitigating risk? So this is the free rolling part of the trade, which can be a little bit confusing at first. So I've got an example here that we'll be talking through, and also these levels. So hopefully that there will make sense. And then we'll talk about a little bit of the optimizing profits too. And I've got some supply and demand scales over here as we start looking at these candlesticks and the very large volume bars, and I'll help you understand what is going on there from a supply and demand perspective. Before we get into it, I want to let you know MarketSmith are the sponsor of this video. If you're interested in a discounted trial of MarketSmith, there is a link in the comments below. So let's jump on into it, and let's just do an overview of the primary learning points. So what are you going to be learning in this video? Well, there are six different types of candlesticks that I'm really looking for as a basis developer. Now all of these link back to what is going on from supply and demand. So if you're looking to trade a breakout, let's just reverse engineer this. Ideally, you want to identify a very strong stock that has evidence that there's large demand that's moved into a stock. Then as that base is building, you're looking for evidence that there is absorption of supply. There isn't much supply coming to the market. Mark Minervini uses the wringing towel analogy. So think about water being wrung out. Think about that supply being wrung out. And there's various things that you can be looking for visually. So hopefully this video will help you in terms of visually understanding what it is you're looking for. And Livermore, obviously that famous quote of the line of least resistance, that pivot point for me. So we'll be talking about that. So we're going to be looking at trigger bars. We're going to be looking at tight range bars. We're going to be looking at shakeout demand tails, gap down reversal bars, bullish synchronicity candlesticks, bullish ease of movement. Then in the secondary learning point, this is where it's going to go more in depth, I think. So history rhymes. What do I mean by that one? The best indication for me of how a stock is going to act in the future, how has it acted in the past? Stocks like us have personalities. They have habits. They have common kind of traits, if you like, as well, to their personality. I know that sounds a little bit voodoo hoodoo, but you'll just see it time and time again. I'm going to be talking about the law of effort versus result, specifically looking at this very large volume bar coming through here, and then we see it in the base as well. So we'll be talking about that, and I'll try and help you understand it. We'll be talking about the power of relative strength, which again just basically centers back to looking for those stronger stocks within the within the market. We're going to be looking at the action before the basing period. So looking at the action down here, what do we want to see in the preceding rally? Obviously a lot of demand coming in and stuff like that. We're going to be looking at moving averages as reference points. So where are you looking for certain things to happen? You just see it happen time and time again. So we'll be looking at that. Then we'll be looking at the line of least resistance, which then forms the ending point of the identification for, okay, where are you now actually looking to enter the stock? And then we can go into the control, the mitigate, the optimize thereafter. And then also, this is a subtlety, but the next bar after a bearish bar, we'll be looking at that as well. So let's start from the left and work our way to the right. So we're always trying to tell ourselves a story of supply and demand. So it's actually very visual. It's very creative when you're looking at this and you're trying to understand the story of what is really going on here from a supply and demand perspective. And I'm just going to start down here. Well, I'll come back to this actually, but we can see the stock down here, it gets nice and tight, doesn't it? Okay, we'll talk about this volume bar later, but the stock gets nice and tight. Now I'm doing this on the 1 hour chart as it's easier for coaching purposes because there's more action happening in a shorter time period, so I can kind of explain it better to you guys. I really like the 1 hour chart myself actually, but this is applicable 1 hour chart, daily chart, weekly chart, monthly chart, 5 minute chart, minute chart. It's just supply and demand. You're trying to understand the story of supply and demand. So we can see down here, price action gets nice and tight, so you have lots of tight range candlesticks. You also have some trigger bars coming through, and then you have low relative volume in that period as well. So something to ingrain in your head is tight range candlesticks and low relative volume means there is not much supply coming to the market. That is very, very good. And when we come onto this scale analogy a little bit later, that may start making a little bit more sense. Now, in the preceding rally, there's a couple of things that I like looking for. Ideally, you want to see strength. Now, how can you visually see strength? Well, it's going to be in the candlesticks and it's going to be in the volume. So I'm looking for bullish synchronicity candlesticks, which are widespread candlesticks on a relative basis. Remember, apples with apples, pears with pears. You're not comparing this stock to how Amazon's moving, Apple's moving, Google's moving, whatever. Apples and apples, oranges and oranges. So this is bullish synchronicity. It's widespread candlesticks on a relative basis, and preferably they open near the lower of the bar and close near the high of the bar. The lower, in terms of if price is opening on the low of the bar and closing on the high of the bar, that is a very good indication of strength, especially if it is wide on a relative basis. And volume is confirming that as well. So we have bullish synchronicity, the synchronicity part being between the volume and also being between the candlestick as well. Then a bullish ease of movement candlestick can look very, very similar, and often is very similar to a bullish synchronicity bar. The only difference between a bullish synchronicity bar and a bullish synchronicity and a bullish ease of movement bar is the volume. Okay, it's just the volume. Invariably, it is a widespread candlestick, but it's easily moving to the upside, and this will make more sense when we come on to thinking about the law of effort versus result. And I've got this scale analogy to be talking about a little bit later on. So price is just easily moving to the upside on low volume, which is actually indicating to you there is little supply coming to the market because price is just easily moving to the upside. So you'd like to see this collection of bullish synchronicity, bullish ease of movement bars, a nice strong rally that stays above those key moving averages. Now on this chart here, the black line is the 10 EMA, the blue line is the 21 EMA, and the purple line is the 50 SMA. Now, just as another side point, which I didn't actually put in here, but is kind of a history rhymes point, is you want to look for stocks that are smooth movers. See how this is just a really nice move to the upside like this. It's very, very orderly. Avoid the stocks that are doing this, chopping around all over the place to the upside, because it's going to be very, very difficult to manage. So you want to see those smooth moving stocks. Again, history repeats. The personality of a stock, for whatever reason, seems to repeat. So that's context that we'd like to see prior to the base. Now, during the base, we'll start talking about during the base. There's a couple of things we want to see. So we've seen evidence of large demand moving in prior to the base. The stock's a smooth mover. Nice. Now we're on the lookout for an optimal chart pattern to form. Now, if you're trading breakouts, that's pretty much going to center around VCPs, high type flags, cup and handles, and Davis boxes. That is pretty much it. Now, you can have variations of those. You can have lower pivots, mid pivots, higher pivots within those. But when we come over to it and we start talking about the trigger bar type action, you'll understand that you're still looking for this, whatever chart pattern it is. This is what I'm looking for, okay? But I do just want to talk about some of these bars. Well, let me just draw this out actually again. This is more of, you could look at it, and again, oftentimes you can have a combination of various chart patterns. I would look at this as, you could look at it as a pie type flag, because the stock has powered up from, it was previously just down here from around about $4. It's nearly had a double in there. So you could look at it as a high type flag, you could look at it as a VCP, you could look at it as the Davis box as well. The chart pattern is not as important as what is going on from a supply and demand perspective. So once you've seen a stock that's made a big rally like this, when this base starts developing, you're looking for evidence of absorption of supply and that there is not much supply coming to market. So a few key candlesticks which I've got listed here that you can be looking out for are, number one, shakeout demand tail. So this is a shakeout demand tail. It resembles a hammer type candlestick. So you have this really nice shakeout demand tail. Now, something to be paying attention to is the volume. So think about volume as weight of supply and demand. So the fact that the volume is so low, what is that telling you in terms of the weight of supply on this bar? There isn't much. And then this is where the context and common sense play a big part. The stock has rallied here. What's it up? The stock has rallied around about 70% or so, and we're not seeing much supply coming through at the top. And then you have these tight range bars. Now these are also very good to see as well. So tight range bars, you got 3 of them in here, and look at the volume. What's the volume telling you? There's not much selling pressure. You're just not seeing it in the volume. So already this is looking interesting. Now the base isn't yet built enough in here to be targeting an entry, and we'll just now talk about the moving averages as a reference point. So if you're on the 1 hour chart like this, at a minimum, you would like to see the 10 and 21 EMA clustered like this. See how tight they come in this region in here, and then you get the tight range bars, the trigger bar coming through, the low volume. So on a minimum on the 1 hour chart, I want to see the 10 EMA and the 21 EMA. Oftentimes you can get the 50 SMA, just they're really nice and clustered, and then you get this type of action that we're going to be talking about in the blue box. On the daily chart, you would like at a minimum, ideally the 10 EMA to be there, but you can also then have bases like this, because this could be the 1 hour chart, could be the daily chart, could be the weekly chart as well. This would be a very kind of big base on the weekly chart. So this is more closely aligned to what it is you're going to see on the 1 hour chart and the daily chart, but you'd like to see 10 EMA there. You could also get in the bigger bases 10 EMA, 21 EMA. In a slightly bigger base, you may also get the 50 SMA there as well. So it's understanding the moving averages and using them as a tool, as a reference guide, if you like, for when this base starts building. And this is the deliberate practice point of just looking at tens and tens of thousands of these, and then just going, okay, I'm expecting this to happen here. What is the next part of the story? Because it's a story playing out, right? And it just happens time and time again. So then you're kind of the deliberate nature, deliberate practice of things is you're just saying, okay, yeah, I'm expecting this to be happening there. That's then happening there. Okay, nice. The story is unfolding as I would be expecting. Now again, history doesn't repeat, but it often rhymes. So same thing with the bases. You're going to see these same characteristics playing out time and time again. So then as we go through, gap down reversal bars are also good to see. So gap down reversal bar, it gaps down and then pushes up, such as this bar here. Again, similar to the shakeout demand tail, the level of volume will indicate how much supply is around. So a gap down reversal bar, such as we see here, on low relative volume, such as this black line here is the 30 bar average for the volume. I use 30 bar average for whatever time frame I'm on for the volume. It doesn't really matter if you want to use 20, 30, 40, 50, it doesn't matter. What you're looking at is you're using it in a relative proportion to what is it you've seen. So everything is relative. So gap down reversal bar, low relative volume indicates there isn't much selling pressure coming to market. Okay, good. Now as another side point, it's better if the stock holds the key moving averages that you are using. So see how you have the shakeout demand tail onto the 21. Gap down reversal bar with a shakeout demand tail onto the 21. Then see how it holds in here, the 21. Then see how it starts basing, and then in the latter part of this base, you get a really nice Darvis box now building in this area as well. Nice little Darvis box, really good to see indeed. So that's then talking about kind of the middle of the base. Then as we get over to the final third of the base, if you like, this is where we're really looking for a dry up in volume, these tight range bars to come through, trigger bar to come through as well. You can see that there's another shakeout demand tail coming through, but what do you notice about the volume on that shakeout demand tail? Very little volume coming through. What does that tell you about supply? There isn't much supply coming to market. There's not that much selling pressure. And then tight range, and then see how there's just hardly any volume that session. This is that kind of, if you like, the Minervini wringing of the towel point. There is no more water coming out of that wet towel. Okay, it's been wrung 3 times, 4 times, however many times, but there's just no more water. There's no more supply. And then this is the Livermore point, the line of least resistance. It looks like this. So when you hear those abstract concepts of the line of least resistance has formed, the pivot point has formed, you've got to be able to visually link that wording back to a mental representation. What does it mean? What are you specifically looking for? There should be whatever your setup is, it should be very specific. You should know, okay, I'm looking for this. I have these pictures of thousands and thousands of charts ingrained in my head. This is what I'm specifically looking for. This is what the line of least resistance looks like in terms of a base, in terms of candlestick, so price action, in terms of volume action as well, the interrelatedness of it all, the reference points of the moving averages for where you're expecting things to happen. So we're now just going to link back, and then we'll start going over here. But I want to explain what is a fairly difficult concept to understand at first. So you guys have probably seen this, right? You have a candlestick, and invariably, well, not invariably, but in this instance here, it is a doji type candlestick. The real body, so we're looking at the purple ones now. We're looking at this one and we're looking at this one. The candlesticks themselves are not dissimilar. They're both doji type candlesticks. Price is opening and closing relatively flat. It's a little bit of a weaker close on the first one. There's a little supply shoot. There's a little demand tail. It's a doji candlestick. Now a doji signals indecision. Because if you think about it, price is pretty much opening and closing at the same level. It goes up a bit, it goes down a bit, or vice versa. It goes down a bit, it goes up a bit, closes at the same level. But then we have some very high volume coming through. And you may be looking at that and going, it didn't make logical sense to me. Let me explain it, right? Because this is something that you will see happen a lot, and you can defer what is going on from supply and demand perspective, whether there is absorption of supply or distribution of supply coming through, and then it links back to context and common sense. I cannot stress that enough, okay? You need to be able to understand the context of where is the stock in its price cycle. So is it a phase 1 accumulation base? Is it in the context of a phase 2 uptrend? Is it a phase 3 distributional top? Is it in a phase 4 downtrend? And then apply some common sense to what it is you are seeing. But common sense, as we know, is not that common. So let's take a look at these bars, and I'm also then going to link this into history rhymes, and we're also going to look at the law of effort versus result. So let's specifically look at this candlestick here, and we can be talking about both of these candlesticks, right? So this is our scale. So on every single candlestick you see, there is a scale of supply and demand. Now, this is true whether it's the 1 minute chart, the 1 hour chart, or the daily chart, the monthly chart. It doesn't matter. Every candlestick has a scale, and the scale has two sides. It has the supply side and it has the demand side. Now, think about volume as weight. So you remember those old scales. If you're old, you probably had them where you had kind of grams on either side. My parents had them where you have kind of grams, probably their grandparents, but you have grams either side. It's either side like this, and then you're adding grams to this one, and then you put it here, and the scales are doing that. Okay, you remember kind of the probably Victorian scales or something like that, right? Obviously today it's digital, so it doesn't make sense. Think about a pair or a Victorian scale. Supply on one side, demand on the other side. So imagine here, we have got weight from the supply side pushing down on the scale, as indicated by this quasi-circle weight thing here with the arrow going down. And then we have demand as well. And we have this circle and the blue arrow going down. So this is indicating weight on the supply side, weight on the demand side. Now, what was the result of the candlestick? Well, it's a doji candlestick, isn't it? It just closes tight. The open is pretty much the same as the close, and we have, because we open, so remember our scales are balanced here. Price isn't moving to the upside like this. We'll talk about other candlesticks in a minute. Price is just level, so our scales are just level. So therefore it must mean the weight of supply and the weight of demand are matched on that doji candlestick, correct? It must be. It's all logical, right? However, we then need to think about relativeness here, because the weight, being the volume, is very, very high. So in fact, if I draw this out, it might look something like this. Now, I know that it's a little bit more difficult because it's not relative here. I haven't got another scale next to it, but I'll make the example in a minute. So if you take a look here, this is our pink scale, okay? What we're saying is, yes, there was a lot of supply coming to market on this bar. There must have been, but yet demand was equal to it. Buyers were stepping up and absorbing the supply. So this bar here, given the context of everything we've just spoken about and how it's basing, and then how it bases thereafter for the tight range bars and the trigger bars, this is looking like more so absorption of supply going on. And then it's also then important to, number one, think about context. Number two, use some common sense. But number three, have a Bayesian mentality. What does that mean? It means you're updating your decision-making process as new information becomes available. So as new information becomes available, as this base progresses, you're then looking back and going, okay, this was happening there, that was happening there. It's a very creative process. You can't, maybe we'll be able to train kind of AI machines to kind of learn this, but it's extremely kind of discretionary. There's a real art involved in this. It's much more art than science, really, for how you're interpreting different things, the interrelatedness between it all as well. The stock, is it in this group which is moving very well? Is it in this group which is actually very weak, but the stock is a lone ranger? So again, lots and lots of kind of webs here in terms of thinking about both the stock, the interrelatedness of the group, the brother sister stocks, the overall market, yada yada yada, right? So anyway, I'm getting off topic, aren't I? But this bar here, what we're saying is volume is very high. We've got a lot of effort coming through, but demand is equal to supply. Now, if we were to look at the next bar, okay, so I'm now just going to move it across to say this bar here. The candlestick is very, very similar. The supply shoot is a little bit higher on this bar, but for all intents and purposes, pretty much the same. But what do we see? Well, the volume is under half the volume of the prior bar. So what's happening here from a weight perspective on our scales? Well, now we're doing this. We're not doing quite that. We'll talk about that in a minute. But now, see this? We're now shrinking. Okay, that weight, that volume is going down. So yes, supply is coming to the market, but there's less supply coming to the market, and demand again is equal to it. Now, if I was to just draw the trigger bar over here and the tight range bars, so imagine we're now looking at, well, imagine we're say looking at this bar here, where I've drawn this this green this green line towards it. Okay, this is a tight range bar. Think about this from a supply and demand perspective. Very, very tight, similar looking candlestick, not too dissimilar, but take a look at the volume. There's no volume. So then when we think about it, it now looks like this, doesn't it? Our scales look like this. Now this is happening for every single candlestick you see across all time frames. There is always supply on one side and demand on the other side. Now hopefully that kind of rambling there helps you make sense visually for what is going on. And just while we're on the topic, let me just draw the scales and give you the analogy, okay, of bullish ease of movement and bullish synchronicity as well. So let's just try and make this one here bigger. There we go. So like this, and we're just going to do this with our scales. So let's draw, say, a bullish synchronicity bar, because now our scales, so imagine we're doing this bar over here, okay, this bar here, this bar here, this bar here, this bar here, there, any of these bullish synchronicity bars. Well, what are we saying here? Well, demand, price, first and foremost, we have more weight on the demand side of our scale. We know that because our scales must do that because price is going up, right? So we have more weight on the demand side of the scale relative to the supply side of the scale. Make sense? So you can visually see here in terms of the weight, and you need to kind of, then what I have in my head is every bar, I have a picture of a scale. Okay, this is what I see. When I look at the price and I look at the volume, I see a scale like this. So obviously I can't draw 50 scales in a row here because I can't fit them all on the chart. But this is what I'm seeing visually in my head, the mental representations, deliberate practice. And there's a really good book by Anders Ericsson called Peak. I would highly recommend you read the book and or listen to the audiobook, but about building the mental representations. So this would be potentially a bullish synchronicity. We could also see something like this for bullish synchronicity as well. We could see something like that. Now let's do a bullish ease of movement. So let's say this bar here, okay? Price is easily moving to the upside, and even imagine it's the next bar as well, but the volume is around about half the 30-day average, as you see on this pink bullish ease of movement bar. Well, what are we saying there? Well, price is easily moving to the upside. So already we know there's very little weight. Now I'm over exaggerating here to emphasize a point. And actually there's not much weight on the demand side of our scale. But demand, we don't need much weight on that side of the scale. Why? Because there's very little weight on the supply side of the scale. So our scale is doing this, price is moving up nicely. Now obviously on the other side of that there is bearish synchronicity as well. So imagine if I did this like this, and then you see those bearish red candlesticks easily break into the downside. That would indicate that we have an imbalance of supply and demand. Now getting on to the trigger bars, you actually want to be looking for areas of extreme balance in the market, agreement in price, and then you are looking to trade the imbalance. That is what you are trying to do. You are looking for the balance, and then you're trying to trade the imbalance. So let's start talking about that, and I'm going to switch these back the same way. So let's now start getting into, well, actually there's one more thing that I want to talk about, just to bore you a little bit longer, right? Because I want to talk about this bit, and then we'll go into the trade management things. It's just my observation. You're not going to read about this in any book. This is purely my observation of looking and trading thousands and thousands and thousands of these. Okay, is this: when you see a bearish bar in a base and or in an uptrend, pay very, very, very close attention to the next bar. So I'm just going to point to arguably bearish candlesticks. Right? We've got this one here, this one here, this one here, this one here, and it's probably those ones. What do you notice about the next bars? So we've got this bar here, we've got our gap down reversal bar here, we've got this bar here, and we've got this bar here. This is consistency of supply point. Do you see any consistency of supply on the next bar, on the next bar, on the next bar, on the next bar? No, you don't. That there is a very constructive sign to see, applying context, common sense, Bayesian way of thinking. There's no consistency of supply. When you also look at those red candlesticks, what do you notice about the volume? No volume, no volume, a little bit of volume, but not much volume. What's that telling you about selling pressure and that supply side of the scale? There isn't much supply. So when you see quote unquote bearish bar coming through, on the very next candlestick, you want to see either a bullish reversal candlestick, so that could be a bullish synchronicity bar, bullish ease of movement bar, or a bullish absorption bar. So that could be a tight range bar, it could be a shakeout demand tail, so on and so forth. It could be a gap down reversal bar as well, could be an inside bar, which can combine with a tight range bar, shakeout demand tail, so on and so forth, right? That is what you are looking for, just a little kind of subtlety there. Now, relative strength, ideally, I'm be quick on this point, ideally you want to trade a stock. I've got a maybe blocking it where I put this video, but search my name on TradingView and the indicators, you'll find it. RS line, super duper helpful. Ideally you want to trade stocks that have a nice healthy RS line trending up. During the base period it can quite easily go sideways, but again you want to see kind of that intermediate to longer term is up for the RS line preferably, right? So let's now start dialing in and talking about this part over here. So we've identified our line of least resistance is forming. We've got multiple tight candlesticks. We've got the volume drying up. This closes out the session. So these vertical lines indicate the end of the session and the start of the session. Now, the pivot point for me is $8.19. The pivot point is not here. It's not $8. It's not $8.35. Why? Because price supply has stopped coming to market around this level. And if we just backdate this out, so we've got kind of that trigger bar. Do you see how the vast majority of trading has been in this blue zone and below? We don't have a lot of overhead supply here. That's another subtlety to also be looking for. So the pivot for me is $8.19. So this is where we basically come to the end of the first part. There's a lot that goes into the first part, the identify. Now we move into the second part, which is controlling risk. So we want to think about two things. Number one, we want to think about where are we going to be wrong? Where does the chart basically kind of sour? Where is it where if price goes there, we're wrong in our analysis? This comes back into the mental representations of what do you expect to happen next? My expectation is if I see this setup, my expectation is this. Bullish synchronicity breakout, it just goes very, very quickly. So if price takes out the low of the day, which would then also be through the 10, the 21 and the 50 SMA underneath these recent lows, I'm off in my timing. I'm wrong. So I want to get out quickly. So I can just get out. If it resets back up, great. I could be looking to target it again. And you may say, well, the prior day is very, very similar. It's the volume point. See the huge volume coming through? This was still indicating there's still supply coming to market. Whereas this day here, really tight, low volume all session. Really, really good to see. So we can then be thinking about the controlling risk, and then we can be thinking about the mitigation of risk, and the two go hand in hand as well. So I have different scenarios when I'm looking at a stop, because I could be going in, and we're going to be talking about the free rolling here as well. Because if I'm going to place my stop loss at 6% underneath the low of this trigger bar here, for me to sell 1/3 of my position to free roll it, I would need a gain. If I maintain my stop loss there, I would need a gain of 2 times that, which is 12%. Now I'm just going to explain free rolling to you. Okay, it's again, you're not going to read about this in Livermore's book, Minervini's book, O'Neill's book. This is my own kind of concept. So here it is, right? This is an example. Imagine if you buy, and we're keeping the numbers and the shares really, really simple so you understand the point. You're probably not going to be buying 3 shares of $100 stock, right? But here you go. If you buy 3 shares at $100, so imagine here, $100 is our pivot point, and you have a 3% stop loss on your position, so $97, okay? Your total risk on the trade is the amount of shares that you buy times by the dollar stop, so i.e. it's $3, so 3 times 3 equals $9. So your total risk on the trade is $9. That is what you are risking total on the trade. Now, if you were to sell 1 share, which is 1/3 of your position, and this is what I'm talking about here with these mitigate free roll levels. If you were to sell 1 share, which is 1/3 of your position at $106, that would be a 6% gain, which is 2 times your stop loss, which means what? Well, it means you've locked in $6 profit with your open risk left of $6. Why? Because you still have 2/3 of your position, which is 2 shares, each with a $3 stop. So remember, you've got 2 shares left, each has a $3 stop because it's at $97, 2 times 3 is 6. So your position is now free rolled and 2/3 of the position is left. Does that make sense? So you're buying at 100, your initial stop is at 97, you sell 1/3 of your position at 2 times your initial stop and or where you're bumping your stop up to. That means you've then free rolled the position. So here we go. Imagine here, as you're looking at this, where would be the next logical place to either potentially put your initial stop and or bump your stop loss up to? because in the mitigation part, in the free rolling part, it doesn't necessarily have to be where your initial stop loss is. Have different scenarios. Those of you who've played sport at a high level will know you have to be adaptable. You can't just be rigid and go, my opponent was supposed to be hitting the ball there and they hit it over there, so I'm just going to stand here. It doesn't work like this. Adapt, adapt, adapt. It links back to that Bayesian way of thinking. So for me, where's the next logical place? If we put some numbers on this as well, maybe it'll make it easier for you guys to see. So let's say we were going to go in with an initial stop of $7.64, but then we realize, well, price is really tight here at around about $7.87. So you could potentially go initial stop at $7.87 as well. Now I just want to put a percentage reading on there. So let's say that's 3.5%, and we've got one here which is 6% as well. Hopefully this is making sense. So what is 2 times 3.5? Hopefully you can all work that out. 7%, right? So let's just draw this up. So 7%, where is that going to put us? That's going to put us around 880. And think about round numbers as well, okay? Ideally you want to look to have your stop losses just underneath round numbers, and you want to be free rolling just underneath round numbers if it makes sense to. So we've got these 2 green levels in here, because now we're thinking, okay, we could have an initial stop at 7.64, which is 6%. Or we could have an initial stop at $7.87, which is circa 3.5%. Or we could go initial stop at 7.64. Then if price starts moving out and we get a 7% gain, we're going to move our stop loss up from 7.64 to 7.87. And then we're going to sell 1/3 here, which we said was around about 880 at 7%, which is then 2 times where our new stop loss is. So it's 2 times wherever the stop loss is. That could be initial stop loss, it could be moving your stop loss up, because when price gets up here, visually you can see it, right? When price gets up here on the breakout, and this is where you have alternative scenarios. So again, different scenarios, being able to hold those in your head, kind of mapping it out, thinking about it, because you have a choice here, right? So first candlestick, you see this breakout bar coming through here. For all intents and purposes, let's say you're up 7% and you get filled, bang there, you place your stop loss there. So on this bar here, you had a gain, you had your whole position, and you had a gain of 7% by the close of this candlestick. However, you still have your stop loss down here at $7.64, so you have a 6% stop. So your open risk on the trade is still 6%, okay? Or would you rather have 2/3 of your position and you push your stop loss from 7.64 up to $7.87, so your stop is now in here and you have 0 risk on the trade? Which position would you rather be in? Such is the nature of risk mitigation and free rolling. There is no right and wrong answer here. There's no right and wrong answer. There's just alternative strategies, alternative potential solutions to, it's not necessarily a problem that's coming up, but the game is playing out. And you have to decide, how are you going to play the game? It's very, very creative. How do you want to play the game? Which trader do you want to be? Yeah, have your whole position have 7% gain, but you still got a 6% stop on it, or have 2/3 of your position, which are sat at 7% gain and have 0 risk. I know which trader I want to be. So be adaptable, have different scenarios that you're thinking about. I think it is really important. I cannot stress it much. As O'Neill said, okay, the secret is to lose the least amount possible on your losers. As Ed Sakota said, if you can cut losses, you may stand a chance. I would add in, if you can free roll as well, you may also have a chance. So think about cutting losses very quickly. If you are wrong, think about where that is on the chart. Think about mitigating risk. You take all of the risk out of the trade because then we move into the optimizing profits, and we never have any idea. We could free roll the trade here, next bar we're stopped out, break even. It could go to the extent where I can't free roll it because it just logically it isn't prudent to do that. There just isn't that opportunity, and I get stopped out. Happens a lot, right? But what I want to do, and the trades that I want to be involved in, is I want to be involved in the ones that are setting up like this, everything that we just spoke about across various different time frames. Then I want to free roll very quickly. So I want to take all of the risk out. I don't want to lose any money on the position. I want to protect my account, and then I want to position myself for potentially a big move with 0 risk. That is the game I'm trying to play. Be involved for potentially a big move with 0 risk. So the position that I'm trying to get myself to very quickly is there where I have the potential to be in a stock that can make a big move. You can think about the beta, you can think about the ADR of the stock, you can think about the quickness of the stock as well, but be there risk-free. And that's the game that I'm trying to play 100 times, 1,000 times, 10,000 times. That is what I'm trying to do over and over again. So then in terms of the optimizing profits, I would think about, again, you can go and study and you can go and create your own rules as well. But I would suggest either using a trailing stop with a moving average. You can decide whichever moving averages you want to use. I like using the 10 EMA and the 21 EMA. If it's a more commodity, choppy related stock, I may bring in the 50 SMA. It depends on relation to the 50 SMA when the stock is basing as well. The 10-week line, if you're on the weekly chart as well, can be effective. You can use this 10, 21, and 50 as well if you're on the 1 hour. If you're on the 1 hour chart, if you start thinking price gets extended from the 10 EMA, what I like doing is lower the day, lower the day, lower the day, or I should say lower the bar, lower the bar, lower the bar. Let me give you an example. So there are no right and wrong answers. People always want right answers, or they want right answers, or this is right, that's wrong. There is no such thing. There is no such thing. There is no right and wrong. There's just different ways of doing things, right? So imagine you bought this breakout here. See how it's kind of tightening up? Imagine that you bought it down here somewhere, and you're now in this trade, right? And you free roll it. This bullish synchronicity bar, you free roll it into that, and now the stock starts moving out. And here you go, whoa, holy smokers! This is extended. I just want to sell. I just want to sell. I'm up wherever multiples of my initial stop or whatever it is. Okay, what I would say, and I've made this mistake more than 101 times, is lower the bar, lower the bar, lower the bar, because extended stocks can become much more extended, as can oversold stocks can become more oversold, right? So imagine if you went here, lower the bar, lower the bar, lower the bar. So you get knocked out here. See how effective that is. Now the close below the 10 would have been here, the close below the 21 would have been over here. It is an extremely effective way if I think the stock starts getting extended from the 10 EMA. That could be on the 1 hour chart, could be on the daily chart as well. I like using the 10 week, which is pretty much the 50 SMA on the weekly chart. Maybe I'll bring in some really longer term moving averages if it's a kind of a phase 1 base and it's consolidating around them nicely. That there's going way into the weeds. But think about having trailing stops with a moving average, because you can see oftentimes price can just bounce off of those moving averages. So I like waiting till the close. But I think if I think it starts getting extended, even here, right, lower the bar, 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 lower the bar. Make sense? So that is it, guys. I'll wrap it up there. Hopefully that video was helpful for you in terms of thinking about stocks before they base, how they base, thereafter the base, thinking about the trade management, thinking about effort versus result, thinking about what it is you're actually seeing from a supply and demand perspective as well, thinking about the trade management, thinking about mitigating risk, free rolling trade. So Sun Tzu Art of War, position yourself beyond the possibility of defeat, I would add, as soon as prudently possible. So hopefully you enjoyed that video, and I will see you in a future one.